Hello, hi. Yeah, so just wanted to kind of go a bit further from my last video about whether market has bottomed in the stock and whether it's time to go long and time to collect. Many stocks, as you can see, companies has gone through a huge correction from big tech. Like Meta, Facebook has down to about 60 over percent until some analysts has to also start to value it as value stock. It's gone down to way back to its 2015 period. Amazon has corrected as well, and the last one standing, Apple, has corrected down to about 129, 28 ish. So um, so I think has the market definitely now is at its maximum fear, with its geopolitical issues coming ahead, and also things like the threat of Taiwan and China war and COVID resurgence and all those things. And so many banks are putting up recommendations um, that there will be further market downturn. And for me, I always like to take the contrarian view. When the fear is the maximum, it's actually the best time to enter the market. And market has been correcting for a year and 9 months, as I said mentioned before earlier. So back to the earlier part about jobs. If you look at the revised jobs data, it shows that actually jobs net there has been a net job losses. I just want to show you about this overcounting, whereby if you can see full-time job down 28 to minus 288, part-time job up 883, and then the other one is multi-holder 683. It means that if you cancel them out each other, it actually shows 100 and something, and then there's a loss of 288, so it still show a red bar. I just wanted to show you how this works. Just 1 second.
What do we get here? We actually get a decline of full-time employment by 288,000, a net increase of part-time employment of 886,000, and multi-job holders up 684,000. Point is, between March and December, it looks like we've actually on net lost full-time employment. Yet, what does the Bureau of Labor Statistics tell us? Well, they tell us that we've actually created 2.1 million more jobs than the household survey shows. But what kind of jobs are we potentially creating? Well, it doesn't seem to be full-time work. It seems to be a lot, to some degree here, part-time and multi-job work. Now, this is a little wild because you have a Federal Reserve that is starting off with looking at these headline numbers. And they're saying, looks like we have wage inflation. Looks like we have more jobs being created. It's time for us to be more aggressive and talk about how we're going to raise interest rates more. But it seems like there's a very real risk. The Bureau of Labor Statistics isn't actually doing the best they could, and maybe they're trying, but it's hard for them with the data they have. But it doesn't look
So you can see the Bureau of Labor Statistics may be incorrect, but of course, based on the last December report, they were looking at the initial report that I mentioned, which was the rise in the jobs number, and that of course makes if job market is hot, means that there's still a lot of the economy activity, consumer spending power is still there. People are still not many people are jobless. More people are having jobs. So this is something that will continue to cause inflation to increase. So this is something that the Fed wants to do to work on, and these data are important. But if they look at the data which is incorrect, then they may overcorrect and it may crash the market. As we mentioned before, the Fed has always wanted to go for a soft landing. Even recession, you can have a mild recession, you can have a crash recession. So a mild recession is what we are looking at, and I believe will happen. Um, So I just wanted to show you that the stock and the bond jumps as investors shrugs off hawkish minutes. Basically, Fed has always tried to talk their way down, talk their way into fearing, to make the market fearful, so that people do retrenchment and all that. And usually, the stock and bond and fund managers, the stock are the bonds fund manager are usually correct, and they actually do not believe in the Fed hawkish minutes, which are creating a lot of fear. They believe that Fed is there to kind of not to kill the market, but just to injure us a little bit, by 20-30%, and then they will start to try to stimulate the market again. So bond trader dismisses Fed hawkish tone bet on 2023 rate cuts instead of the market talk of rates continue to be higher in 2023 and longer period as well. So usually, wait, let me just show you about another thing about the savings rates, to show that market is actually consumer has been um, uh, hammered, and you can see the chart here. Consumer savings is at its all-time low. It's pretty near to 2010 period. So another thing I'd like to show you are two other points, which is the consumer withdrawal of EPF. They call it 401k in US. There's been a maximum increase withdrawal, and then you look at another part, which their utilization of credit cards, which has also increased to use to sustain their lifestyle, which are also showing that consumer actually do not have much savings, and they're using loans and debts to sustain their lifestyle. Okay, watch this.
Months after. That's incredible. That's insane. So hardship withdrawals are skyrocketing during this time, but that's not the only thing that's happening. Households are borrowing a lot more on credit cards than they previously have. Take a look at this. This goes all the way back to April of 21. What do we get here? Credit card borrowing skyrocketing from this level here, sitting around the 20% threshold, skyrocketing to about 35%. So a massive explosion in the amount of credit card borrowing. But what I personally found very interesting was that first, we saw money from savings or from selling assets increase. But that actually has decreased here recently, potentially as people don't have any assets left to sell because the stock market, for example, has fallen so much, or they've depleted their savings. So now the rate of change for credit card borrowing is actually inflecting up at the same time as we're getting a down inflection in money from selling assets or savings, because people are out. People are potentially out of savings. They have no stock left. Now they're left with borrowing money from credit cards. And what's also interesting is even borrowing from friends or family, the yellow line, has started to trend down, which somewhat implies that even friends or family are running out of money. That's also quite scary.
So yeah, you can see these are all very important points that shows that us consumer has, especially in the US, has suffered a great deal in 2021 and 2022. So I believe that market will turn in 2023. As you can see, way back in the .com, the Lehman Brothers crash, 2008 and 2009, it was also a downturn for 2 years. And then after that, the market starts to swing upwards. So I hope you like the video, and please like the video and subscribe. Thanks a lot.